Welcome to Unfiltered Finance. I'm your host, Emily Turner. We have a special guest with us today, Mize Khan of 1 million to 100 million portfolio project. And I feel like the title says a lot, but why don't you tell us a little bit about more specifically what it does and where this idea came from?
Yeah, for sure, for sure. So the idea actually came from like a short question answer session with Warren Buffett at one of the annual meetings. I think he said something along the lines of, if I had only $1 million to invest instead of the billions he had at that time, I could guarantee you 50% a year return. Um, and essentially, he said that, hey, if I focused on small caps, companies that are much smaller, where there's more of an edge, I could get a much higher return. And then I kind of took that and I saw that there were lots of other investors that were writing online or sharing kind of what they're doing online, or it just kind of came out after the fact that had achieved those types of returns with a smaller base of capital. Um, a couple of examples in that space might be Ted Wexler, who works at Berkshire Hathaway now. I think he took his Roth IRA from 70,000 to 100 some million dollars. Or sorry, 70,000 to $40 million, I believe,
Well,
or
that's
somewhere in
quite
there.
the
Yeah.
improvement.
I think it was a 40% compounded annual growth rate over 23 years. Um, and, without ever taking it out, it came out as a result of I think, a Freedom of Information Act kind of thing. And he's like, yeah, that's true. That happened. And then there's another investor that I look up to. His name is Dan Shum. He runs a blog called No Name Stocks. And as a part-time investor, he has invested in very, very small, mostly US companies. And over, I think, 12 or 13 years, he's had a 30% compounded annual growth rate. Um, and so to take that and then apply it to the $1 to $100 million project, the idea was that if you can do about a 30%, 36% annualized return over a 15-year period, you could take $1 to $100 million, essentially doubling every 2 years. And it's entirely possible. People have done it. People have done better than that. Um, and um, and I love investing. So once I sold my last company, I decided, hey, I want to go back to kind of just, reading a bunch of 10K filings and having fun doing it, and having a goal. In the process of doing that. And that's how it came about.
Reading a bunch of 10K filings and having fun doing it. I'm glad that there is someone who thinks all of that is fun.
Yeah.
It's funny. I'll sit down sometime. Well, not sometimes. Annually, I'll sit down with my portfolio manager, and it's like 11% this year, 20%, and I'm like, that's great. But this is a much higher percentage for folks who might be like, there's no way. I mean, what do you say to the doubters?
Yeah, I think, before I really got into it, there were two parts to this. One, I had 70% of my, so I'll give a little bit of my background just to add to this. Before my last company, which was a corporate team building company, which I did for 6 or 7 years, I was at a hedge fund for about 4 years, where we focused on large caps. And even there, we were able to beat the market, but just by like a couple hundred basis points, 2 to 3%. Um, but when I kind of moved into investing for myself and focusing on smaller companies, and I think you had Swen on here a couple weeks ago, and the stuff, the weird shit, the stuff that nobody really wants to pay attention to. There's no analysts. I took a sleeve of my portfolio, maybe 25%, and started focusing on that. And I did so well that I moved 100% of my portfolio to that sleeve. And so I've done it over the last 3 or so years at about 38% annualized. So I haven't hit Buffett's 50%, but I think it's definitely possible. And there's a lot of people that have been doing it for a long time. You can find them online thanks to Substack and the blogs that exist today. But and you don't need to get, I don't expect to be able to hit 50%. Maybe one of these years I'll do like a 50, 70% gain. But I think on average, you have to expect the volatility, but you can definitely beat the market.
When it comes to the way that you do that, I mean, most people be like, oh, let's do the safe things that we know are going to appreciate. We're going to do Apple, we'll do Nvidia, we'll do whatever. But that's not where you focus. What is your focus specifically? So how do you do it?
Yeah, so there's another part to this, right? So I've been at a hedge fund before, and the problem with focusing on Nvidia, focusing on Apple, is that you're competing with one, really smart people, right? I can guarantee they're very smart people. Two, they're also very well funded, right? Your whole portfolio, let's say if you have $1 million portfolio or a $500,000 portfolio, they're going to spend more than that just on the research services related to the one, their Nvidia position. So they will know weeks or months before you, um, which direction the quarter might go. And I'll give you an example, right? So I think there was a hedge fund that I knew that would hire drone specialists to go and count the number of cars at Walmart parking lots. And they would know how many customers and if the number of cars have increased versus the previous quarter, or they would hire a drone to go look at oil, refineries and how much oil there is in those, I forget what they're called, in those containers that are sitting outside using infrared cameras. And you just can't compete with that, right? So they have data that you can't get. Whereas in small caps where there's only one or two analysts or in many cases no analysts, and there's very little institutional investment, you might be like the third person reading the 10K, right? Nobody reads these things. And so you'll find really interesting opportunities that the market just misses.
How do you decide where you're going to even look, though? I mean, there are so many companies that you could potentially read their 10K, but what is it that's like, I got to read this company's?
Yeah, that's a good question. I think so. There's a bunch of different ways that I think about sourcing ideas. One is, now we have, what you're doing, what a lot of other people are doing. There's a lot of content out there where people are surfacing interesting ideas all the time. So I have like a curated list of people that are friends of mine, that have become friends of mine as I've been writing, that surface interesting ideas that they come up with or that they see through other friends or through screening these companies. And if it comes from one of them, I'll definitely dive in, right? Two, I also run screeners using, Koifin and Ticker and all these other companies in specific areas, looking at companies below, $300 million and then trying to find companies that are exceptionally cheap or exceptionally, low price compared to how much cash they have on the balance sheet. So different types of screens to find things that are just odd at that price. And that has a much lower hit rate, right? So usually when things are cheap, they're cheap for a reason. And so I think those are kind of the two really clear ways. The other one is just going through one at a time, right? So pick a market that you think is cheap. Recently, I've been doing this in the UK, I think is really cheap as a market from a value perspective. And you just kind of start below $200 million market cap and just kind of go one after the other and try to see what you can find. And a lot of it should be cheap, but there's plenty that you can find that shouldn't be.
Yeah, it's interesting you talk about the UK market. Swen said the same thing when I interviewed him on the channel, which all those videos are available below. But when it comes to that, right? Like you guys, this is what you do every day. This is your bread and butter. But for someone who maybe doesn't have that opportunity, is this still something that they have access to, that if they get curious, they could go look up?
Yeah, for sure. I think if you're not a full-time investor, and I wasn't when I first started this, right? You might not want to do this with your whole portfolio. One, two, it depends on your investment style. If you're buying for the long term, so if your bar is pretty high and you're thinking out 3 years, on average, the number of decisions you have to make in a year might only be like three or four, right? So it's actually very doable as a part-time investor. And following, other people that are writing about this, like Swen and myself, um, or following even other funds that are really small. So there's some really great microcap focused funds that you can follow their letters and learn a lot about how they do this. I think that's definitely valuable, and you can still definitely beat the market because I've done it using that skill set.
When it comes to some of the specifics, can you tell us, a couple of examples for folks who might be watching and are interested in trying this out?
Yeah, I can give you an example from the recent past of a type of company that I invested in, and that was Dallas News. Very small company. I think it had a $40 million market cap, but if you're from Texas, you've heard of it. It's a very big newspaper called Dallas News, and it was an interesting company because the whole company was trading at around $40 million, and they had a factory, really old factory, maybe it's 50, 70, 100 years old or something like that, worth $40 million in terms of just land and building value. And they had already committed to selling it. And they said, hey, we expect like somewhere around $43 million out of selling this, and we'll move to a much smaller space and save a lot of money in terms of uh, just annual costs by doing so, just because they had moved online quite a bit instead of just print. And so you could buy this company for essentially the cost of this building that was going to close in a couple of months. And then you'd get the rest of the business for free. And then the one other additional factor there was if you follow kind of the industry generally, the newspaper industry, that's been a highly consolidating industry, right? So I think Lee Enterprises and a couple of other companies have been buying up these newspapers because they have this great base of subscribers that's likely to stick around for a long time, and they can
Oh
reduce.
yeah, I mean, I was in news for 20 years. I lived through it when it came to TV stations, so I know what you're talking about.
Yeah, for sure. And so that was another kind of, you knew that there was like a floor value there to that business itself and those subscribers that was just getting zero value. And so I was able to buy that around $40 million. I think it was $4 something per share. And within, I think, 6 to 9 months, the stock got bought out after they had sold the land and building for somewhere in the range of 12 to $14. And there was a bidding war because of this consolidation going on. So I actually sold too early because the bidding war pushed the price even further up.
And what was the time from purchase to sell?
Probably only 9 months, right? So, it's interesting though. It's not easy to hold these, right? Because a lot of people that are not following every little thing might get cold feet very quickly. And so, when they sold the building, they had previously indicated that they would, give the money back to shareholders via dividend. And then in the call right after, they kind of or said nothing about the dividend at all. They just completely ignored it. And I don't think even any analysts were on the call or they didn't ask about it. And so nobody knows like uh, what happened here. Where's the money that you're supposed to be giving back to us? And a lot of people sold the stock down. So it went from 4 to 6 something, so up 50% and back down to 4. So back down to below cash value, and you're like, okay, what do we do here? And when I went back, I looked at it again. I'm like, all right, I own this thing. Should I sell it? Should I, are these guys just bad managers? And so then you have this really long history with these companies, right? You can go back into their 10Ks for many years going back. And these guys had always given money back. They'd always been great about shareholder returns. And I held on. I had some friends that sold and didn't really get much out of it. I held on. I was like, no, there's something going on here. There's still this angle around the private buyout. And I think maybe 3 months later, they announced the buyout.
So that would be my next question for you. So somebody who's maybe going to try and venture into this realm, is this something you can just say, "Oh, I'm going to take this company, and this company, and then walk away? Or do you need to monitor it more closely because the time domain for some of these decisions is shorter?
Yeah, so I think it depends on the type of um, the strategy that you go in with, right? So my strategy is I'm pretty open to different types of investments. I do kind of investments that I think are really long-term compounders and are under earning based because they're reinvesting out of their P&L back into their growth. And so they look like they're really expensive. They might be at a P of 70, even though in truth they're at like a P of 10 because most of their money is going back into growing. Um, and a company like that that has a good moat, you can actually buy something like that today and not have to worry too much about it because you know, hey, there's a great management, they have a history. It's just the reason it's cheap is because it's too small. The there aren't any good analysts or there aren't enough institutions in this space. And so it's going to be cheap until it gets bigger, but it will get bigger and it'll get discovered over time. And it'll start to earn a lot more once, they can't just invest all of their free cash back into the growth just because they've gotten too big. Um, and so that an example of that is like this nicotine pouch company Hype that I can talk about, but or Remitly is a larger company kind of like that where they spend $300 million a year on marketing, but they could just stop spending 90% of that and become like a seven times price to earnings kind of company today, and
Right.
they still kind of maintain their earnings. So if you do mostly that, which I focus on, you can do really well without having to make decisions really often. Um, Dallas News is an example of a special situation where you might you know that you're getting it below cash value, and so you might have to make more decisions because there's a special situation angle to it. But even there, you can like the person I mentioned, Dan Shum, he often, if you're buying below cash, like there's not a lot of downside, and so what's left is kind of just upside, right? So if you buy a bunch of those, you don't have to worry too much about it either.
Right. There's not much runway in the wrong direction.
Yeah.
For folks who might be interested in getting into this, we'll include a link to your newsletter for folks who want to follow you in the description below. But just what is your key point, your key bit of advice to someone who might say, I think I want to try this.
Yeah, I think the big part, there's some really important things that kind of led me to this path. One, there's a lot of great resources around books and investors that I recommend people learn about, from Buffett to Joel Greenblatt to Peter Lynch and Phil Fisher. I think they've all written books and or have had books written about them, and most of them are fantastic. So those kind of became the base of the strategy, and it works really well in the smaller markets. Um, and two, I would start kind of the way I did: take a portion of your money, put it to the side, play with that until you feel like you're getting really comfortable with your own investment strategy, and then slowly add more over time.
Perfect. All right. Well, Mize, thank you so much for your insight and coming on the show. I appreciate it.